Good afternoon. Happy Friday. Hey guys, this is Craig Modelmog with the week ending March 26th. This episode of Wall Street X's and O's. Geez, I almost forgot. See, I get this COVID fade thing at the end of the day, and I really start feeling like crap. So it's a real and live. They talk about these long haulers. Tanya told me I was a proud member of the long haulers with COVID. So I'm glad. It's good. For those of you watching for the first time, this is uncut and unedited. I just kind of hop on, I let it rip. The whole focus of the show is really focusing on the things that people, the press, the news are not talking about. I'm real big on that because it's a lot of the things, it's sifting through the weeds to find, or sifting through the pits to find the cherries, a very old adage. But anyway, I'd like to welcome you if you are here for the first time. If you're not, you guys know we kind of have a good time. I got a really good show today. I got some good stuff. I get excited when I have good stuff. I'm going to hit a unemployment milestone. I'm not diving into the unemployment numbers, although they were a little better. I'm going to hit really then move on. Number two, or the second big topic, is going to be some sector performance and the whys, because there's always a reason why things are performing the way they are. And then lastly, I've got some great COVID pandemic stats, not related to COVID, but related to what's happening. And this will be good. So I'm excited. I'm really excited. So kick things off today. First of all, my team got beat in March Madness. As many of you may know, I'm a Kansas Jayhawk fan. I am actually an honorary member. As much money as I send to University of Kansas, my son's a graduate of their undergrad and grad school. My daughter is a junior there, and so I've become a big Jayhawk fan. So my team got beat. My bracket's terrible. So it's been a year of the upset, which this has actually been a lot of fun to watch. So we've got more games tomorrow and Sunday. And hey, I'm picking some more upsets. It's a COVID year. How could we not? Seriously, how could we not focus on upsets? So anyway, it's good. It's really good. But anyway, let's go back to this pandemic. Actually, it is a pandemic milestone, but unemployment. This is interesting. This is the first time, actually in a very long time, okay, that the unemployment claim for the week exceeded the pre-pandemic numbers, which if you go back to pre-pandemic, we were averaging a little over 200,000 a month in unemployment numbers. That's pretty traditional. 211 was the week of, and I can't even see here. March 6, 2020 was 211,000. March 13th was 282,000. And then it just skyrocketed, 3.3 million, 6.8 million, and it's been a train wreck ever since. We've had 52 consecutive weeks in excess of pre-pandemic levels. I don't know if that's something to celebrate. It is a statistic. And as you all know, the numbers don't lie. And it's fascinating. It is. It's just I kind of like this stuff. Good thing is numbers were a little bit better from this week to last week. I'm anxious to see those numbers continue to improve. The kicker is what type of acceleration of improvement. That's the big thing. The rate of change is a big statistical fact that I focus on. So I'm anxious to watch that. Okay, let's move on here to the second topic, sector performance. For you tech freaks, which there are a lot of them, you've got hedge funds that were charging people 2% up front or 2% on an annual basis, and then they would take 20% of the earnings. They call it a 2 and 20 setup for hedge funds. I should be hedge fund manager. Those guys really make bank. They rip people off because most of them aren't worth a crap. But what I find interesting is they were buying Amazon and Apple and Facebook, all the FANG names, thinking they were geniuses and then charging people a buttload of money. What's interesting is Goldman Sachs came out this morning and said, it's a rough year. All the institutions and all of the hedge funds, for the most part, on average, are down 2.5% per year. Boo-hoo. Oh yeah, cry me a stinking river. I don't feel sorry for those suckers at all because they rig everything and they make too much money, and I'm going off on a tangent here like I do when I get fired up. So I'm just glad I didn't start stuttering or forget, because that's what usually happens with my little COVID fade experience. But anyway, if you look at sector performance, technology performance as a sector is negative for the day, except for today, the month, the quarter, and year to date, basically down 0.5%. Consumer staples are also negative. Staples are the things that we use on a regular basis, but you've seen spending decline significantly. What are our top performers for the year? Well, you've got energy, you've got industrials, you've got financials, and you have, what am I looking for here? Communications, materials, not materials. Materials have been good. I think it's materials. I don't think it is. I think it's the top three. We're going with the top three. See, I told you. I kind of prepare this stuff throughout the week, and then I get today and I just let it rip. So the kicker is why, okay? If you look at this year, what have we been in? We've been in a period of interest rates rising, inflation rising, the US dollar declining, okay? Which, what does that do? See, all these things impact each other. And when you look at why is energy the number one performer? Well, when you have a dollar going down and you have inflation rising, that pushes prices higher. That is oil prices, that is gas prices, that is natural gas. When you look on the commodity side, which we've owned commodities for about the last 6 months and made a ton of money in it, I might say, it's because of the inflationary component that is taking place. So you've got a government that's passing out stimulus checks because people are hurting for cash because they're not working. And then because of that, the dollar is being devalued, to which they want the dollar to go down. And it's making the prices of goods go up. And it is screwing the people that they say they're helping. It's bait and switch. It's like, hey, watch my hands. Smack, and they smack you on the other side of the head with the other hand. It's garbage. It ticks me off. But anyway, so when you look at the cause of what's happening, you have to look at how everything is connected. Everything is connected and intertwined. So again, look at the dollar. If you get the dollar right, you usually get the market right. Interest rates, yes. Inflation, yes. Right now we are in a solid economic environment of growth accelerating along with inflation. I anticipate that to go for another quarter or two, okay? I think we're going to print some incredible GDP numbers for not so much the first quarter is going to be good. The second quarter could be a number like we haven't seen since the 50s, which is post World War II, and that's why we had that type of a GDP number then. So we're coming off a pandemic that is really, really starting to stir the pot. It's a fascinating cocktail, as they say on Friday afternoons, for those who drink cocktails, of which if I didn't feel so tired, I would probably have one tonight. But with my COVID recuperating, I have abstained. So anyway, moving on here, we're going to look at some fascinating statistics. These are COVID relating. And then I have a COVID commentary. And I'm going to be out early today because I'm tired, okay? I do get amped up for this. So I know you can't tell, but really I'm tired. I probably need a nap. I may have taken a nap today. No, I didn't. But anyway, looking at here, and these are interesting. Since COVID, 89% of Americans now consider China a competitor or an enemy rather than a partner. Fascinating. Fascinating. Not a shocker. Not a shocker at all. Looking at homicide spikes. I know I'm getting morbid here, but we saw a 30% year-over-year increase in homicides in 34 American cities. I guess being pent up gets people, I was about ready to say a cuss word, and I know there's a few people on this that watch this that would be appalled. It gets a few people fired up and they start thinking crazy, okay? They get crazy pent up. So yeah, major increase in homicides, which is I always find fascinating when you look at this stuff. If you look at the federal debt, they are saying the CBO, which is the Congressional Budget Office, they are predicting the federal debt will nearly double to 202% of GDP by 2051. We are in 2021 now, people. And what I find interesting is not so much the double by 2051. That means right now our federal debt is in excess of 100% of our GDP now. And I just heard the other day when Sleepy Joe, it's funny. We went from President Pump, and what many of you are on here, I kind of am in the middle, and I kind of rip on both parties. I'm one I call a spade, okay? So, and you'll see that. We had President Pump before, which was all jacked up. He loved the being in the limelight. He loved being on Twitter. Now that he's shut down, he's having withdrawal symptoms, so he's starting his own social media network, supposedly, so he can get back out there. And then we have Sleepy Joe. They finally woke him up so he could do his first frickin' press conference the other day. So we have these two dynamics going on, right? Well, what I also find fascinating is Trump really is a closet Democrat. He used to be a Democrat. From a fiscal responsibility standpoint, Republicans and Democrats both, if I had a piece of paper, garbage. There's no fiscal responsibility right now. Zero, okay? We had massive spending last year. We have kicked off the year with another stimulus bill, and now they're talking about a $3 trillion infrastructure bill. $3 trillion. You notice how when we were in the financial crisis in 2009, about how Congress balked at a $700 billion TARP program to bail the country out from cratering in the worst financial crisis on record. And now we just float around burning logs of dollar bills in our fireplace talking trillions. I'm going to technical foul it, beans we are in the March Madness time of the season. I'm calling a technical foul. See, I get fired up on this stuff. We're spending too much damn money. We can't keep doing it, okay? Somehow you have to pay for it. Sadly, we have a government now that is embracing the attitudes and the perspectives of other countries that have just overspent, and now they just print money when they have to print money, and their economies are garbage. And I digress, but it's Friday, I'm tired, I can get a little fired up. At least I haven't started cussing or anything, which, I'm trying hard on that. I used to cuss on this show, and then my wife would get mad at me, and she's rightfully so I'm getting better. But anyway, I'm rambling, see? Here's another sad stat. Trend in 2020, drug overdose deaths hit another record high, again, due to pandemic. And I'm not being morbid, I'm focusing on the pandemic and the causes, because the causes of this then move and translate into, from an economic standpoint, what's happening, which and then translates to how we position and make money. There's always ways to make money no matter what is going on. That was called Wayne's World Extreme Close-Up. You see that? Yep, and I know some of you are probably going, Model Mog likes Wayne's World. I used to think it was a good show. I thought it was some good humor. So anyway, so opioid deaths have skyrocketed, and that's really, really sad. Another trending stat. Birth rates. Here's an interesting one, okay? When you look at World War II, when everybody came home, what happened? That's babies popping out of ladies all over. That created the baby boom, okay? Here's what's interesting. Birth rates were down in 2020 by 4.4%. You know why? People were hanging out too much and they started hating on each other. I think that's kind of funny, personally. So, oh, dang, you gotta love it. See? And this is all transitioning and translating to the economy. So here's what we've got going on. We got people, we've been cooped up for a year. Okay, we had terrible unemployment numbers for 52 weeks. We had all these bad things, people shooting up on each other, shooting things in their arm and dying, no more babies. Things are not very happy. People are in a not happy place. As things reopen, what's going to happen? We have $1.6 trillion sitting on the sideline, and we are not savers in the United States. We are spenders, okay? I think we're going to see some spending. Look at retail numbers. Let's look at things that people are buying. Let's look at travel. Of course, we got the COVID effect where they're still freezing the big cruise lines, and we have seen things increase on the airplane, passengers. So see, I'm starting to struggle, and I'm going to blame that on my COVID slowness, which happens on occasion. But anyway, all this translates to an economic impact. That is how we are positioned right now. Okay, that's why we are positive year to date, and all these smartasses on Wall Street are negative. That's what I think. I'm excited. Okay, but again, you have to follow the data. You have to follow the data, because you know what? And this is my closing comment here. And I know I'm shutting it down and a little bit early. I'm at 15:49. Tanya told me to do 8 to 10 minutes and be done. I always have great intentions, but then I start yapping and getting fired up, and look what happens. But if you think about this, the thing I love about the stock market, it's a lot like a game, okay? And the best part of it is this. There is an undeniable score at the end of every day in the market. The last price is the truth. Much like if you get to the end of the game and you have a score, you won or you lost. That's why I love competing in athletics. That's why I love the markets. You know why? Markets don't lie. People do. The data doesn't lie. People do. When you look at the news, see, you can tell this is uncut. This is a toll-free call from a spam. Later. So anyway, in closing, always follow the data. Follow the dollar, follow interest rates, follow inflation. Those three things are interconnected and will dictate what happens eventually in the markets. It does. I promise you. That's why my global dynamic asset allocation strategy works so effectively. Is it foolproof? No. There are times when it doesn't perform, and I'm not going to lie, there are times. But all in all, over a full market cycle, it gives us an opportunity to participate in the entire cycle, not just during specific periods. So with that, this is Craig Modelmog for this week's episode of Wall Street X's and O's. I appreciate you guys tuning in, and this is Modelmog out.